Hey there, Marco Lima here, and welcome to our September 25 market commentary. Risk appetite remains strong, with the S&P 500 posting a fourth quarter consecutive month of gains in August. The S&P 500 set new record highs during the month. Corporate credit spreads are their tightest since the 1990s, and the VIX is falling back below 15. Powell's Jackson Hole speech set the stage for rate cuts, and the Treasury yields fell, and leadership rotated as small cap stocks outperformed, with the market pricing in the September rate cut. Solid Q2 earnings help support the S&P 500's expensive valuation. However, earnings growth appears to set to slow, leaving little room for error at today's valuations. Recent data show pockets of strength in consumer spending and housing, although the labor market data softened in manufacturing contracted. July's data reinforced the slowdown thesis, but point to a gradual slowdown rather than a recession. Technicians remain constructive, with the S&P 500 above key moving averages and solid market breadth. However, momentum has slowed, suggesting equities may need a fresh catalyst. Let's talk about our market outlook. And starting with the bullish side of things, the Fed has softened its stance, and Chair Powell's Jackson Hole remarks, as mentioned earlier, hinted at a possible September rate cut, which could ease pressures on consumers and businesses. Trade tensions have cooled down for now, with new deals struck with Japan and the EU and an extension of the China agreement. Corporate earnings beat expectations in Q2, and the combination of trade progress and steady economic data has stabilized the outlook. The new tax bill includes measures designed to spur business investment, and economic data stabilized recently after softening in early Q2. The secular AI growth story remains intact, and mega-cap stocks are translating AI capex into real earnings growth. Let's talk about bearish things to watch out for. Valuations remain elevated across stocks, housing, and credit, fueling a talk of everything bubble. Speculative trading, especially in meme stocks, signals that parts of the market have detached from fundamentals. The July labor market reports showed noticeable cooling in the labor market. Inflation is flashing yellow. Headline CPI matched expectations, but core CPI rose at the fastest rate since January, and producers' prices surged, indicating that inflation pressures are building upstream. While AI capex remains strong, investors lack clarity on those investments and has their will translate into durable profits. Government shutdown risks is building up ahead of the September 30th deadline, with the Congress yet to pass the 2026 spending bill. Our view, we see a late cycle expansion that is narrowing, with data pointing to slower growth. Its sustainability rests in three factors. One, how quickly the Fed begins an easing cycle and whether it can cushion slowing growth. Two, whether the AI-driven capex booms continues to drive GDP growth and translates into productivity fast enough to justify today's expensive valuations. And three, the extent to which tariffs reignite goods inflation. The backdrop remains constructive, but is balanced on a Goldilocks narrative. Further gains depend on AI capex, solid earnings, and the Fed rate cuts, but a gradual economic slowdown and tariffs introduce downside risks. Stay calm, stay invested, and please let us know if we can assist you further. Visit mraadvisory.com to learn more and schedule a conversation with one of our advisors. Have a great day.